So let's jump into it. My name's Dan Bowman. I'm the president of the bank, and I'll be acting as chair for tonight's meeting. And there we go. I'll be acting as chair for tonight's meeting, and Jeanette Young will be acting as secretary of tonight's meeting. So with that, the meeting is now called to order, and our agenda for this evening is to elect the board of directors. Of course, we do that every year. To ratify the appointment of our auditors, Ide Bailey, to report on the activities of the bank, explain what we're doing, and then conduct any other business and answer any questions you might have. So it's a good time. We're experimenting here a little bit. The idea was, let's make this more like a mixer. Let's make it more informal, a little heavier on the food and, of course, the bar. This is the highest paid group of bartenders you've ever met. But anyway, so that is our agenda for this evening, and hopefully we can have some fun along the way. But let's start off, as most of you are probably aware, we start off each one of our board meetings with prayer, and our shareholders meetings with prayer, and staff meetings with prayer. So with that, I'd like to start with prayer. And Bernie Wolfswinkel has been conducting our prayers for many years. Bernie will be 91, by the way, in August. So let's keep Bernie in our prayers to stay in there. And he'll be joining us virtually. He pre-recorded the prayer earlier this week. And with that, Josh, you ready?
Our gracious Heavenly Father, I want to come to you this evening to give you thanks for all the things that you've done for us. We're holding our annual shareholders meetings tonight, Father, and we appreciate that you helped us through a lot of good years that we've had. I also want to thank you for the shareholders. Without the shareholders, Father, we would not be able to have a bank, so they really helped us a lot at the beginning of time. Be with the families of the shareholders. We hope and pray that they are all okay and healthy. Watch over each and every one of them. Also, I want to thank you, Father, for the employees at the bank. We really appreciate what they have done for us over the years, and we need their help and assistance. I want to thank the board members for all the efforts and all the work they've done for the bank to make this a successful bank. And you saw the meeting records that we had a good bank again, a good year this past year. Now be with these people that are here this evening, Father. Watch over them and protect them. You know, I've lost a couple of good friends this past year, and I'm sure everybody here tonight has lost some of their friends. So be with them and watch over them. We ask this all in thy most precious name, our dear Lord and Savior, Jesus Christ. Amen.
Amen. Okay. Terrific. Well, thank you, Bernie. And I think Bernie is joining us virtually, so he is watching what's going on here. Next item on our agenda is the flag salute. Roger, would you lead us in the flag salute? Allegiance to the flag of the United States of America and to the republic for which it stands, one nation under God, indivisible, with liberty and justice for all. Amen. Thank you, Raj. And now, normally Bernie would lead us in singing this song, God Bless America. For 23 years we sang, I think, every shareholders meeting. But Bernie can't be here to do it, so his favorite sidekick is Gigi. And she loves karaoke, loves singing, loves all that stuff. So with that, I think we're ready to go. Gigi? Yeah, sure.
If you could... Test. Can you hear me? Oh, there we are. If you could all please stand and join me in singing God Bless America. This is a sing-along. I don't have the bouncy ball, but maybe next year. God bless America. land that I love. Stand beside her and guide her for the night with the light from above. From the mountains to the prairies to the oceans white with foam. God bless America, my home, sweet home. God bless America, my home, sweet home. God bless you, everyone.
That was great. I think that's the best one we've done yet. We're getting better. She's getting better. Yeah, it was good. Yeah, Bernie's got a fast tempo. He gets through that song quick. Well, let's see. This meeting is being held pursuant to the call for the meeting by the Board of Directors and the proxy statement and proxy voting card, together with an annual report that hopefully has been sent to every shareholder. It went out to everyone. We have, for some of our shareholders, they have their shares in what's called street name, and so we don't see that. It just shows the broker's name. So it might say TD Ameritrade or something like that, and those proxy packages are provided to TD Ameritrade, but sometimes they don't make it there just as quick as we'd like. So if you didn't get one, let me know and we'll get one to you. If you're inclined, you can go to our website and you can look up the proxy statement, the voting card, annual report, all of the above. And if you go to the annual report on the website, you'll see that Roger Caberto's picture is on there as one of the directors. If you get a paper one, you'll see that Dan forgot to put Roger in the book. Oh, you go over all these details and footnotes and, all the math and everything else. And there's always something that gets by. And Roger's so gracious. I sent him one and he just kind of very politely. So, where's my picture? Anyway, so that is what's happening there. Number two, this is called a contact card, and we try to ask for this every year because people change phone numbers or change addresses or that kind of thing, and so we ask for an update on the contact card so we can keep up with people. And in the past, we had a basket, and there were flowers, and it was nice, and I had a picture of a basket that was nicer than the one we actually give. But this year, the girls decided, what the heck, let's do something a little more fun. And so they put together a safe with money in it. So at the end of the evening, we're going to go to the tumbler. We're going to pull out a contact card. And the person that put that in is going to win this safe with that money and that pig. There's also, she's going to fill it out right now. There's also, I don't know, there's a bottle of bourbon there, and I don't know. There's a thermal mug to disguise it like coffee. Anyway, whatever. It's pretty neat. It weighs a lot, that's for sure. So anyway, don't miss that. So in terms of introducing our board of directors, we've seen Bernie, you've seen me. Richard Malooly, I think Richard is, there he is. Richard Malooly is vice chairman of the board. Pardon me? Okay, that's his picture. These pictures are, they're about 12 years old, and we don't want to give them up because we were so young back then. But anyway. So Richard Malooly is a real estate professional, and he is now retired-ish. But he still keeps working. Yeah. I think for realtors, you never totally retire, You keep answering the phone. Linda Cooper, president of Inland Empire Escrow. There's Linda. She's in back. Jeanette Young. There's Jeanette. And Julio Cardenas. Julio, there you are. All right, great. Tom Woodbury. Tom's in the back. Excellent. Tom is a physician. He is not retired, so if you cut yourself, Tom can take care of you. See, I'm volunteering your services already. Ken McElvaney could not be here tonight. He had another thing he had to be at. Ken is a retired insurance executive. Ken took care of the bank's insurance for many years, for about 20 years for us. He's a great guy. He's definitely an expert in the industry. And our our newest board member, Roger Caberto. Roger knows almost nothing about the bank. I'm kidding. Roger Caberto is one of our founding leaders at the bank. Roger and I started this bank 23 plus years ago when it was a hope and a dream. And, we had some basic principles. Let's treat it like it's real money. Let's treat it like we'd like to get it back someday. And it served us pretty well. Roger has been a steady hand. This last September, after 22 years, Roger retired. What a flake, huh? No, Roger's a dear friend, and I miss him to death. I didn't realize how much I talked to this guy, but now I'm talking to myself, in fact. So anyway, he's a great guy. And Roger, when he retired, he agreed to join our board of directors, and he is now the chairman of the Directors Loan Committee. So anyway, thank you, Roger, for all of your service and everything you continue to do. So good. And I would like to take the time to introduce the whole staff, but there's too many of them. Carol tells me we have 57 now. Yeah, that's a lot. And they all want to be paid. I don't know. Yeah. Every morning we do this, we call a 5-minute meeting, and it takes 25 minutes. But anyway, and part of it is you call on people, and you can't imagine how hard that is. I've worked with these people for years, and it's like, give me a hint. What's your name? I don't know. Old age, Alzheimer's, something. I'm not sure what it is. Ide Bailey. Is Karen here tonight? Okay, maybe Karen is on the way or joining us virtually. I'm not quite sure. So Karen Perkins, the partner that handles our relationship with the CPA firm of Ide Bailey, is joining either virtually or in person. Similarly, the law firm of Stewart, Moore, and Staub, Ken Moore, is one of the attorneys that takes care of our business, and Mike Staub. I think they're both joining virtually. They're in Central California. And Hilltop Securities, Mike Natzik was going to be here, but he had to have a procedure on his eye. And so I told him, I'd blow that off. Come to my thing, I'll feed you. But anyway, it was pretty important for him, so he couldn't be here tonight. And this is the slide that I thought I was on earlier. So now you caught me in that one. This is the proxy statement that was sent out to everyone. And with that, now we'll go to the business part of the meeting. That's where we're going to elect the board of directors, and we're going to ratify the appointment of the CPA firm. And to handle that will be Julio Cardenas and Carol Murdahl. And Carol, there you are. Okay.
Good evening. Hello, check. Is this thing on? You can hear me? Okay. Good evening. This meeting is being held pursuant to the call of the Board of Directors and the legal notice of the annual meeting dated April 18th of 2023. May I hear a motion to waive the reading of the legal notice and to attach the secretary's certificate to the minutes of this meeting? Second. Very good. It has been moved. All those in favor of accepting the certificate of the minutes of this meeting signify by saying aye. All those opposed? All right. It has been moved and seconded that the reading of the legal notice be waived and the secretary's certificate be annexed to the minutes of this meeting. I think we did that already, correct? All right. Well, that says, may I have, so hold on one second. Oh, this one? Okay. All right. Certificate of mailing notice of meeting. A certificate of the mailing showing that the notice of the annual meeting and proxy statement were properly mailed has been filed and will be annexed to the minutes of this meeting. The board has appointed Carol Murdahl to serve as the inspector of election to count the votes, determine the validity of proxies, and decide on all questions and challenges arising in connection with the election. Will the inspector of election now give the quorum report?
Of the 2,676,799 shares of the company's common stock outstanding as of March 19th, 2023, which is the record date for this meeting, 1,851,620 shares, or 69.17%, are represented either in proxy or in person.
Thank you, Ms. Murdahl. Since 1,338,400 shares are necessary for a quorum and 1,851,620 are represented, a quorum is present. Therefore, this meeting is duly organized and can proceed with conducting business. As you know, there are two legal actions to be taken at this evening's annual meeting of shareholders. Number one, the election of the company's board of directors, and two, the ratification of appointment of independent auditors. Since the company has not received any notices of intention to nominate directors pursuant to the company's bylaws, cumulative voting will not be necessary. Therefore, we will dispense with any explanation of cumulative. I would like to announce that the following 9 candidates have been nominated for election to the board of directors to serve until the next annual meeting of shareholders and until their successors are elected and have qualified. Dan H. Bowman, Roger Caberto, Julio Cardenas, Linda M. Cooper, Richard G. Maluli, Kenneth McIlvaney, Bernard J. Wolfswinkel, Thomas A. Woodbury, Jeanette L. Young. I would like to entertain a motion to elect management slate of directors. Do I have such a motion? Do I have a second? All in favor of this motion signify by saying aye. All opposed signify by the same sign. The motion has been carried by voice vote. As you probably know, your proxy card gives you the ability to vote against individual candidates, in addition to being able to vote in favor of or against the whole slate of nominees. As a result, different nominees may have different numbers of votes. Now, I would like to call on the inspector again for the official result of the voting. Ms. Murdahl, could you please tell me the least number of shares voted, authority given, with respect to any of the nominees for director?
1,726,328.
And the total number voted, authority withheld?
4,663.
Thank you. Management's 9 candidates have officially been re-elected to serve as directors for another year. The second item of business is the ratification of appointment of independent auditors. As indicated in the proxy statement, this proposal is not legally required, but the board has chosen to voluntarily give the shareholders the opportunity to ratify or not ratify the audit committee's appointment of the independent auditors for the upcoming year. The audit committee still has to be the body that makes the ultimate decision about the selection of the company's independent auditors, but is interested in the opinion of the shareholders concerning its decision. May I have a motion to ratify the appointment of Eide Bailey LLP as the company's independent auditors for 2023? Do I hear a second? Second. All those in favor signify by saying aye. Aye. All those opposed by the same sign. The motion has been carried by voice vote. Now I would like to call on the inspector again for the official result of the voting. Ms. Murdahl, can you tell me the number of shares voted for and against this proposal?
There were 1,849,720 for the proposal and 938 against.
And the number abstaining?
962.
And can you also tell me the percentage of the shares represented and voting that were voted in favor of this proposal?
The percentage of shares voting in favor of the proposal was 69.10%.
Thank you. This proposal has been approved. Will the Inspector of Election please file your certificate of voting results when completed with the Secretary?
Yes.
Will you, please? This concludes the formal business portion of the meeting. I would now like to call on Dan Bowman for his presentation about our 2022 and future plans. Thank you.
Thank you, Carol. Thank you, Julio. Yeah, I've got one already. Let's give him a hand. That's a lot of work. All right. I got to tell you, this was a tough year for me. Normally, preparing for the shareholders meeting, I don't know, I put in pictures of cats or something like that, and I have fun with it. This was a hard year. I don't know. There's so much bad news out there. In the morning, I get on my stationary bike and I ride and I watch, Fox News or something. And there's always some guy on there saying, oh, the banks, they're all going to die. So then I holler at the TV. It helps my heart rate get way up there, though. It's good. Anyway. So I guess, the question I would have is, what is with the banks? What's going on out there? It seems every day there's another event on the news. Of course, Silicon Valley Bank, First Republic Bank, Pacific Western, they've been in tough times. Signature Bank, Silvergate, what's the crypto, not crypto, Credit Suisse? Wow, when did we become worried about the Swiss? That's the second largest bank in Switzerland, and they've got a lot of loans here in the United States. So let's see if we can't make some sense of all of this silliness and what's going on. So we'll go all the way back, leading up to the pandemic. So keep in mind, we're going into the pandemic. We're all worried we're going to croak from this COVID thing. I remember it was March the 19th. We had a board meeting, and Tom is looking at his phone, and he says, the governor shut down the economy for 2 weeks. And I was like, yeah, right, you can't do that. Okay. So this had never been done before. What do you send everybody home? What is that going to do to the economy? GDP is going to hit 0 because nobody's making widgets. We're going to run out of widgets. How does that work? And the rest of the world was in just as bad a shape. It's not like we could get widgets from Canada or something. So the Federal Reserve kind of panicked, and their total balance sheet at the time, about $3.7 trillion. Okay, now keep in mind, this is an organization that they can print money. It's pretty cool. Ben Bernanke figured that out about 2009 and said, dude, I got a checkbook, and it doesn't have a total at the bottom. So at any rate, they'd run this up from about $893 billion to about $3.7 trillion. And when the pandemic hit, they went nuts. $8.9 trillion. That's That's an increase of 140% increase in their balance sheet. And it's not just their balance sheet because they print money that constitutes that balance sheet, and they'll buy treasuries, and they'll buy mortgage-backed securities, and they'll support the administration and a variety of things. So they expanded the monetary base by about 140%. That's a lot. But again, you know, the economy's going to stop. GDP is going to go to zero. Maybe we'll need that thing. Okay, fine. So, sure enough, as you'd expect, bank deposits ballooned up at the same time, and they went from about 13 trillion in total aggregate bank deposits across the industry, ramped up to about 18 trillion. Okay, there's that 5 trillion again. Well, all right, at least we know it got through to the banks, and boosted those by about 5 trillion or 38%, because banks had other deposits. All right, so the banking industry swells up. Deposits were huge. Our little bank here, we had a 42% increase in deposits in 20, followed by a 28% increase in deposits in 21. And in our business, you don't get double-digit increases in deposits. That, you know, unless something really bad happens. So to get those back to back was a big deal. That was significant. So then we look at the money supply. This one's really kind of cool. This is M1. So M1 is the most basic. It's cash and checking accounts. M1 went berserk, as you can see. It was idling on there at about 1.5 trillion. And again, this is cash on hand or cash in checking accounts. You know, it's a part of the economy, but it's not the lion's share of the economy. That jumped up to 7.3 trillion in overnight. And I think we all knew that. You know, people were getting checks in the mail or PPP loans or a variety of ways that money was coming to them. And I think it made a lot of people kind of nervous. So you just kind of sat on it. Government's going to want this back. I'm just going to leave it there and hope they don't notice. And PPP loans represented very significant amounts. When we think about a year's worth of payroll, that's a lot of dough. And but it came at a good time. Many businesses were negatively impacted by the pandemic, and it got them through that time. All right, so we get this huge swell in M1, and we're going into what is going to be a horrible storm, but we're in good shape. We got a lot of gas / money. And so let's see how that goes. Well, all right, so this is GDP, gross domestic product, right? The sum total of all goods and services going into the pandemic. That little thing at the end is when the pandemic hit, first quarter of 2020. All right, and we are ready for this to go to zero, right? Except it didn't. It actually increased. How is this possible? You send half of the workers home and productivity goes up? It's not supposed to happen that way, but it did. So apparently those people that still worked hard because they made up for everybody else who stayed home. And of course, you know, that caught everybody off guard. Productivity shouldn't increase. Productivity should have decreased. And now everybody's got a whole pocket full of cash and staying home and not happy with how this house looks. You know, who tried to get a contractor to come out and do something? Yeah, they would, you know, you'd call them, yeah, I'll get to you in August. It just was tough because there was so much demand going. And so this is, you know, an averaged out GDP slope over the preceding number of years. And then as we see the slope after, not only did GDP increase, it was increasing at a faster rate than it was prior. So it was growing faster. I think we should send them home and leave them home. But anyway, that's me. So this is core CPI. Okay, so CPI, Consumer Price Index, that's / inflation, right? So Consumer Price Index tries to monitor what your dollar will buy. And it's indexed to a particular point in time, and they look at a bunch of basket of goods and services, and they see how much the price is, and based on that, you calculate inflation. So if we look at CPI going back a number of years, and for many years it was about 2.4%. It would average. It would get a low of 2.0, get up to 2.8, and it would bounce around. And the Fed's express objective was 2.0 for many years. They wanted to reach a 2% inflation rate. Okay, fine. And kind of did. Everything was okay. And then Janet Yellen comes out, my friend Janet, comes out and says inflation is transitory. And by the way, I like Janet. She was the president of the San Francisco Fed when I was there, and I was there for 3 years. And so I must have had, I don't know, a lot of dinners with Janet, and she's a nice conversational person. She's just a nice person to hang around. But she's having to, carry some statements here that I think are tough. She's got to carry the party line. And one of them is, inflation's transitory. It's not a problem. When I joined the Fed, that first time I started to pay attention to Ben Bernanke, he came out and said, well, now keep in mind, this was '08. He said, the economy's not too bad. We see a little bit of foam. Yeah, that was the Great Recession, was a little bit of foam. I think it's important to be careful when you say things because then everybody remembers it. So anyway, Janet came out and said, inflation is transitory. It's not a permanent problem. It's not an issue. Don't pay any attention to the man behind the curtain. And then it became not very transitory. And this, by the way, is core CPI. Now, core CPI takes out food and fuel. Headline CPI, which is everything in that basket, is estimated to be more like 10.5. It was a pretty high number. And heading higher faster. So now, keep in mind, so the Fed panics. We're going into a pandemic and they throw a ton of money into this thing. And now it's taken off, and now they're panicking the other direction. How do we get this thing back? So, and by the way, the two buzzwords are QT and QE. So QE is quantitative easing, right? Making it easy, lowering interest rates, shoveling out money. Okay. Quantitative tightening, or QT, you don't hear that one very much because they don't do it very much. And but we are clearly in the QT category now. And the two tools for QT is getting money back that we put out there and raising interest rates. Those are their two tools. And so you think, well, how do you get money back? What do we write letters to these people and say, give me that PPP money back? No, they can't do that. But what they can do is they've got what's called the reverse repo markets. And that's where banks put money on deposit at the Federal Reserve. So last night, I think we had, $92 million at the Federal Reserve. And it's overnight. It has full faith and credit. It's a zero risk-weighted item. Heck, I gave it to the government. At any rate, but that took that money out of circulation. Kind of removed it from the economy, so to speak. So we put out $5.2 trillion and we got back about $2.3 trillion. Okay, well, that's some of it. That's making a little bit of headway. And then the next item are interest rates. Now, the Federal Reserve sets what's called the Fed funds and the discount rate, and that's the overnight rate. Okay, and it's an index. We look at the potential of interest rate increases. And we say, well, okay, interest rates could go up by what we call 100 bips. That's 1% or 2% or 3%. And we model it and we say, well, if it went up 3%, what would that do to our balance sheet? Okay, fine. And then we really got wild and said, what if it went up 4%? That's not going to happen, but we'll model it anyway. Okay, good. Nobody modeled 525 bips. That isn't on anybody's radar because historically the Federal Reserve has increased in successive increases of about 25 bips. So now, and there are 10 meetings per year, so that's about 2.5% per year. We've gone 525. Nobody was planning on that. And it didn't, tap on the brakes. It was the slam on the brakes, shove everybody through the windshield kind of thing. And that's what we're dealing with now. It's getting a lot of headlines. So 525 bips, nobody was planning for that. And not only that, so we've had that rate of increase. We're still modeling for up 400. That would be a 925 bip increase. Nobody can survive that one. It's tough. So it's called the yield curve. It's a standard yield curve. This actually is the Treasury yield curve from May 25th, 2022. So this day last year, this was the yield curve. And you'll notice over on the right-hand side, that's the short end of the curve, and that's the 1 month number. And on the far end, that's the 30-year number. And so that's how banks make their money. We borrow money from the public and from others short term, right? Overnight, literally. And in this particular case, a year ago, the 1 month Treasury curve was at 58 bips, or 58 basis points. 58 100ths of 1%, right? That's what it was. Okay, fine, cool, like it. The 10-year, on the other hand, was at 276, I think it was. Yeah, 276. All right. The difference between those two, that's how banks pay the rent. They borrow on the short end of the curve at 58 bips. They lend out at the long end of the curve, 276. The 218 or 2.18% interest, the difference, is how banks pay the rent. Nobody noticed. I'm sorry, Josie. There's a seat here. So that's a standardized yield curve. It's typical. That's how the business works. That's how banking works, is with a standard yield curve. Cool. Like it. So on the 17th, this is the same yield curve. I don't know what it is, 6 days ago. 8 days ago. On the 17th, this was the Treasury yield curve. Now you'll notice on that 1 month category, it used to be at 58 bips. Now it's 5.59%. This increased 500 bips in 1 year, slightly less in 1 year. The 10-year, previously 276, now it's at 367. Okay, that's interesting. So if you're a banker, you're borrowing at 5.59 and you're lending at 3.67, that's a minus 1.92. So how do you do that? That doesn't make any sense. And that's what bankers are dealing with right now, is an inverted yield curve. And the challenge is we make long-term loans. And so if you make let's just say a 30-year mortgage loan. There were 30-year mortgage loans made at 2.6%. That's fixed for 30 years. Those loans, nobody's going to pay those off because you can't get that rate again. And somebody owns that note, which is yielding 2.6%, and they're paying 5.59 to fund it. It's a negative spread, and it kills the industry. And if you don't have your house in order, it'll kill the bank. So that's the environment that we're in. And it's, like I said, it's called an inverted yield curve, where the short end of the curve is yielding more than the long end of the curve. And why is it doing that? It's doing it because the Federal Reserve cranked it up. And was that market forces? No. It was a bunch of guys in Washington that said, let's raise the rate to make up for lowering it all those times ago. And they do it very quickly. Now this chart, this is called the 2 and 10, or 2 minus 10. So it's the 10-year Treasury minus the 2-year Treasury. It's a standard reference. And when it gets below that black line, it means it's a negative number, and that means it's an inverted yield curve. So if you take the 10-year and you minus the 2-year, and it's a negative number, it means the 2-year is higher than the 10-year. All right, okay, that all seems kind of geekish. Who cares, Dan? Well, it happens occasionally, and it always happens just before a recession. Why? Because the recession was caused by it. And so, okay, that's interesting to know. And by the way, you can trace an inverted yield curve all the way back to the beginning of inverted yield curves, I think. But one thing that's kind of interesting about us now, and that is the current inversion. If you look how deep this inversion has gone in relation to prior periods, this is pretty deep. And then the question is, how long will it extend? So you can handle a shock to the system if it's just for a day because, tomorrow we're okay. If it lasts for a year, that's going to be hard to get over. And that's the thing we don't know, is how long will the Fed keep up this quantitative tightening, the high short end of the yield curve? And that's what's causing trouble in banking today. Now, this is the Conference Board's index of leading economic indicators. And what this is looking at is the likelihood of recession. So that red line, as you see, that's 4.2%. Anything below that is a strong indicator of recession. And what we can see today is we are below that red line. And those gray vertical bars were previous recessions. And we can see that, we're kind of overdue for one here. So I just throw it in because all of the indicators that we look at are suggesting inflation is here, or not inflation, recession is here. And we're going to have to maneuver through it. So, all right, the Fed takes back money through reverse repo markets. They raise short-term interest rates and reduce borrowing. It has a result on reducing the number of deposits, and we can see this is industry-wide. So beginning in the first quarter of 22, we were at 19.9 trillion, and that has come down about 6% down to the first quarter of 23. Okay, well, that's a significant reduction in the amount of deposits. Okay. Now, if we look at, this is called real M2 money stock, real meaning adjusted for inflation, and this is M2, so it's that same thing, cash and checking accounts, but it also includes money market accounts and some other items, so it's a little bit bigger number. It's not as volatile as M1. We can see it peaked out at about 7.6 trillion. Okay, that's fine. And it's come down now about 6.8 trillion, or off about 11%. In a relatively short period of time. So we can look at some indicators that suggest that liquidity is coming out of the marketplace. What the Fed is doing is having the intended effect, and it's taking money out of the economy, and the next step is to start to feel the effects of that money coming out of the economy. Now, one argument would suggest that if we use just a straight line on the historical long-term growth of M2, we're kind of getting to a point there where we've contracted enough, we'll be where we would have been had we not expanded it. See what I'm saying? If it just kept increasing at that rate and we hadn't done this big thing, we'd have gotten there anyway. So, okay, maybe we've gone on long enough and it's contracted enough, we're back to our previous base. Okay, fine. That's good. That would suggest that we could begin to taper this quantitative tightening and not tighten quite so fast. That's my hope. So primary risks of banking. The first risk of banking, and the one that typically gets banks in trouble, is credit risk. So credit risk is you make a loan to somebody and he doesn't pay you back, and he can't pay you back and you don't have collateral, and that's what causes you to lose your hair. So credit risk is what gets banks in trouble, and credit risk can't really be fixed. The reason is a bad loan that's made is a bad loan that's made, and it's awfully hard to unwind. Roger and I both did that for a lot of years, and it's tough to fix a bad loan. The second risk is interest rate risk, and that's where I make a loan at X, this level, and then interest rates rise above that level, and I get an inversion or a negative spread. So that's the interest rate risk, and that applies to both loans and investments. And then the third is liquidity risk. So keep in mind, we take deposits overnight. These are short-term deposits, or we borrow from the Fed overnight, or we do a whole lot of stuff overnight at that short end of the yield curve. And the challenge with liquidity risk is if I take money from a depositor and I make a loan, and that depositor wants that deposit back, that's where liquidity comes in. And I've got to have enough cash on hand to be able to satisfy that need. I can't say, could you come back next year? I could, but it won't work. So those are the issues that the banking industry in general faces, and the two big ones that are getting us right now are interest rate risk and liquidity risk. Okay? So if we look at some of these banks in the headlines, by the way, WAMU, $307 billion. That was not a community bank. That was a huge bank. It was the biggest bank ever seized in the United States. First Republic, $229 billion. That was obviously the second largest bank ever seized in the United States. I don't remember their ranking. It seems to me they were 12th largest in general. Silicon Valley Bank, I think we've all heard of that, $209 billion. Not a community bank. This is a very big bank. And then, of course, the last one being Signature Bank. These were all very big banks. So when you hear somebody in Fox News saying, oh, the community banks are, well, those aren't community banks. Those are very big banks. And who ended up with these? Well, Chase ended up with these. One estimate is this last transaction done with First Republic. And keep in mind, these are deals done behind closed doors overnight. Banks closed on Sunday, deals announced on Monday. Oh, what could possibly go wrong? One estimate is there's $20 billion benefit to Chase in this transaction. WAMU, that was a big boom for. This transaction was so large, we have a statutory maximum in the United States that says no domestic bank can have more than 10% of all domestic deposits. Okay, that makes sense. Let's not put all our eggs in one basket. We violated that with the acquisition of First Republic. The Treasury Department had to ignore that rule in order to allow the First Republic transaction to go through with Chase because they exceeded 10% of domestic deposits. Chase just keeps getting bigger and bigger and bigger. And I admit it, Jamie Dimon is the smartest guy in the whole world. He's got hair. That's cool. But I'm a little worried about too many eggs going in one very big basket there. So if we look at First Republic, what's the story on that bank? This bank specialized in mortgage lending to high net worth individuals. These are jumbos. These are $1 million or $2 or $3 or $5 million loans to very big houses sitting up on a top of a something, and to people that have got a lot of money. And the deal was, I will lend you $2 or $3 or $5 million on this house if you'll give me all of your deposits, because I can match off those deposits against the mortgage. And even if that mortgage is pretty cheap rate, it's self-funding to the extent that I get deposits, and that enhances the yield. So that was the business model of First Republic. Now keep in mind, again, $229 billion, big bank. That was the 17th largest bank in the country. But they had long-term fixed-rate mortgages. They had it's called a narrow NIM, or net interest margin. Okay, the net interest margin is the difference between what I'm paying for deposits and what I'm earning on that mortgage. Well, it started off pretty skinny, and then it got skinnier. Large depositor concentrations. Again, when I'm dealing with high net worth individual, these are big deposits coming in big chunks. And then finally, rising cost of funds. Those big depositors said, I'd like to earn more interest on my deposit. Oh, that wasn't the plan. And finally, at the end, it was insufficient liquidity. With this particular bank, as I understand it, there was a $140 billion loss in one day.
And that's people pulling their money to get a better interest rate elsewhere on a money market, or what?
People pulling money because they're afraid. Yeah, that's the problem. You start to get this rumor and scandal and whatever, and then people say, oh my gosh, I got to yank my money out. And unfortunately, for this group, they're so far above FDIC limits. They're way above FDIC limits. And they lost too much too fast, and Treasury had to step in and take over the organization. If you look at a couple of graphs, so this is the net interest margin in nominal terms, or dollars. And we can see that builds up quite nicely until the third quarter of 22, where it sharply drops off. Right? And that's third quarter 22 is when interest rates really started to take hold.
Feds took them down. They have to know they're doing that when they change the rate.
Well, I don't know. One would think. Anyway. I agree. Now, hey, this is being recorded. I'm with you. This is also that net interest margin, but this is looking as a percentage, and we can see that goes from about 2.62 to about 1.63, or 100 basis point reduction in the net interest margin. This is a business of 1%. That's what our profit is, 1% return on average assets, and you saw that go to zero in that equation. And then finally, this chart is of their deposits. We can see they built up until about the fourth quarter of 2020, and then they dropped a lot, $72 billion between the fourth quarter and the end of the first quarter. Just huge. And you know, what caused that? Well, a whole lot of things caused it. Frankly, when they were doing this lending program and somebody said, well, what if the Fed cranks the rate 525 bips? You crazy, man. That ain't going to happen. And most bankers would have said, that's statistically unlikely. Yeah. The Fed hasn't increased 525 basis points in a little over a year, almost ever. It's more gradual moves. So Silicon Valley Bank, we'll just keep on this theme of good news. Silicon Valley Bank, now this bank was very different. This bank, they specialized in tech industry. So if you wanted to start a tech company, if you want to start Google or, I don't know, Microsoft or somebody else, you banked with Silicon Valley Bank. And they were involved in capital offerings and international transactions, and so they've got a big Asia market. And I used to sit with their president on the Fed board, and he was in the process of developing a bank in China. It was really kind of a neat, interesting bank, and for many years they were doing just fine. Problem is they had very big depositors. Their largest depositor was $10 billion. If I had a depositor with $10 billion, I would wake up every morning and call him and say, how you doing? Can I swing by Starbucks for you? Yeah. What would you like? Can I drop you off at the office? Whatever you want. You remember Beverly Hillbillies, Mr. Dries? That would have been me. Yeah. Yep. So very large depositor base. So large, in fact, 97% of their deposits, 97% were above FDIC maximums. I mean, we're in the high 70s, so I don't know. And it varies quite a bit. It depends on the style of banking. This is a bank that had a very narrow industry and really big depositors. Abnormally high percentage of their total assets went into fixed income securities, 56%. And they were U.S. Treasuries. I mean, these are good securities. They're not bad. They were just very volatile from an interest rate risk perspective because they don't cash flow. Rapidly rising cost of funds, that mark-to-market ate them up. And then large institutional ownership. So there is a theme that comes, and that is when you've got few but very big depositors or few but very big shareholders, you're at risk. You're always at risk. That somebody doesn't like you, or they get mad, or they want to do something else, or they change their mind, or who knows, they retire. I don't know. They do something different, and it has a devastating effect on the organization. So with Silicon Valley Bank, we can see that really their deposits didn't drop off quite off the cliff like First Republic did. And there was another issue here. You remember there was a question whether Treasury or the FDIC was going to insure these deposits, because keep in mind, all of these deposits are well above FDIC limits. So now this requires an act by Treasury to say, yeah, we're not going to follow our rules. We're going to play outside of the rules, and we're going to insure this $10 billion depositor. And there were some depositors that weren't even U.S. citizens. I don't know. I don't know if he had an account there or not, but it's funny. And, you know, when you think about it, so one of our family's favorite movies every Christmas, we used to have a VHS of this back when we had a VHS recorder. Now I just pay for it on Prime. But anyway, It's a Wonderful Life. And for anybody who hasn't seen it, you got to watch this thing. George Bailey gets married to his wife, and Ernie is driving him to the train station. He says, I don't know about that. Looks like a run on the bank. And George jumps out and goes in there, and sure enough, everybody's lined up, and they're saying, I want my money. Well, why do you want your? Because I'm panicked, and the bank is closing. Potter is going to, take over the bank. And George says, don't do this thing. You've got it all wrong. Your money isn't here in the vault. It's in Mrs. Smith's house and Mr. Jones' house and that sort of. And he's trying to be rational and help these folks understand what's going on. And so finally they're all upset, and that's it. I'm going to go sell my shares to Potter. We're going to do that. And at that moment, Mary steps up, having just gotten $2,000 for their honeymoon, and says, how much do you need? And George uses that. Well, the thing on the top is troubled banks, and that's the Federal Reserve. So, any questions? Yeah. And what happened there is many times you don't have to have every single depositor, but you have to be able to satisfy those depositors that are fearful and reactionary, and they're there. And so in that particular case, Mary gave him her honeymoon money, and they gave the money. And there's a particular scene where this little lady's there. She said, can you give me $2.18? He gives her a big kiss, which I guess that was all impromptu. It wasn't scripted. So that's why it came across so well. Anyway, so that's what the Fed did. Well, the Fed came out. Donna Reed wasn't available, so they put together the Bank Term Funding Program. You probably heard that phrase. That was invented on a Wednesday. Let me see. Silicon Valley was seized on a Friday. Signature Bank was seized on a Monday. Sunday on Signature. Monday afternoon, Treasury said, yeah, we're not so sure we're going to cover those things. Well, then it turns out Gavin Newsom's got money at Silicon, so he's trying to pull strings. Everybody's got strings. I think Putin had money there. I don't know. Anyway, he's calling, making trouble. So on Wednesday, the Federal Reserve comes up with the Bank Term Loan Program. And it is Mary Bailey with a pile of money. Banks can borrow against fixed income securities. Remember when I talked about First Republic or Silicon Valley, 56% of their assets were treasuries, and they didn't have liquidity. Well, here comes a program 3 days late that would have allowed them to borrow 100% of the value, the original par value of those securities. So had this been in place the week before, Silicon Valley could have borrowed $100 billion from the Federal Reserve, covered all the demand, everything would have been great, life would have been good. They were just a week late. This is offered at a fixed interest rate, fixed for 12 months, and it is cheap. This goes out, there's no prepayment penalty. You can liquidate it if you want to. And this is at the 1-year overnight swap rate plus 10 bips. That's cheap money, about 5.25 today. There are two particularly smart bankers, I won't mention who, Melinda and me. I'm kidding. Actually, it just turned out really well. We took an advance on this, not because we needed it, not because we had a liquidity issue or anything else, but get it while you can. And it was super cheap. This particular thing, at the time, and this is priced daily, at the time, the interest rate on this instrument was 4.37%. And the Fed on reverse repos was paying, at that time, 4.75. It's like, you're going to pay me? Dude. So you can't say that to Fed. But anyway, it was very profitable for us. It was financially advantageous for us to do that. It turned out to be a good thing. So anyway. So with all that, this is where I get to the point of the presentation where somebody will raise their hand and say, all right, Dan, what about our bank? That's all well and good. I don't care about Silicon Valley. I care about our bank. So I'm glad you asked. So bank performance in 22, we set a new record for asset growth. We were $399 million in total assets. That was up 6% over the previous year. I'm very pleased about that. In terms of deposit growth, that was up 8%. Okay, good. I love that thing, the way it just does that. If it goes the other way, I'm not going to show it. Loan growth was up 2.8%, and it was a struggle to do that. Loan growth these days is hard for banks, because if I were in the business of, I guess I am in the business of borrowing, but if I wanted to refinance a building or something, I'd say, now's not a good time to do it. Rates are high. I'm going to wait for a while. And so a lot of borrowers are waiting. And as a net result, growing the loan portfolio is particularly difficult right now. So there's not a lot of growth. We did have a 2.8% growth in the loan portfolio year over year, but it's a challenge for us. And not only a challenge because borrowers don't want to borrow right now at this rate, they may not qualify. We may not be able to underwrite them at that interest rate. It's a challenge. And this is kind of important, and this is the slide about asset quality. So as of 12/31/22, or the end of last year, credit losses for the full year of 22 were a minus 69,000. So what that means is we not only didn't have any credit losses, we recovered about 70,000 that we had previously written down. And if you go all the way back to 9 and 10, we'd had some loans that we had written off, and we've been successful in collecting those. So this was I think it's our 8th consecutive year of net collections. So not only no credit losses, but a net recovery. We did have one delinquent loan, and what I mean by that is one loan that was delinquent by payments for 30 days or more, $189,000, and that loan is since caught up. He missed his payment at year end, and he's caught up. Non-accrual loans. Now, these are loans that are downgraded so that we don't recognize the interest on them, called non-accrual. It's total $404,000. It's 3 loans. They're paying as agreed, but they're in kind of bad shape. We don't have current financials, or if we do have current financials, they're not good. One of those borrowers is in Chapter 7 bankruptcy. But in each case, we're collateralized, and there's no reason to believe there's any principal loss. We had no OREO is properties that you foreclosed on. It stands for other real estate owned, and we had no OREO. Our allocation for loan loss reserve, that's what ALLL stands for, was $4.1 million, or about 2.26% of our total loans. So the ALLL was fully funded. We had adequate reserves to cover any unforeseen events in our loan portfolio. Ended the year in really good shape in terms of credit quality. If we look at total revenue, it was up 23% year over year. Very pleased about that at $16 million. And interest expense, that was up 25%. That's the other side of the coin on this, is rising interest rates. Keep in mind our deposit rates move up faster than our loans reprice. And that's where the pinch comes. Non-interest expenses, that's rent and lights and utilities and all that stuff. It was up 13% year over year. I guess we can say it set a new record. Not a good one. Anyway, 13%. And then if we look at non-interest expenses as a percentage of total assets, we're at 1.95%. That was up slightly. We're 1.82 the year before. But as we can see, as a percentage, in general, that trend is coming down. And what happens there is the total assets, the total deposits and loans, increase faster than the rent, and it becomes a smaller percentage. And that's why banks want to grow, so that those costs can be a lower percent. So total earnings, how did that turn out? Well, that was pretty good too. That was up 51%. This one worries me because how am I going to beat that next year? Yeah, 51%. A lot of things came together. It was just a great year. As I mentioned, no credit losses to deal with. Some of the things that can offset an otherwise really good year did not occur to us in 22, and a big increase there. If we look at net earnings after taxes, earnings per share, it was up 46%, went from $1.17 per share to $1.71 per share. So good number there. Happy about that. If we look at the first quarter numbers, first quarter so far is pretty good. Total assets increased 8% over the same quarter last year. Quarterly deposits were down 10%. And remember, we looked at that chart, how deposits across the industry are contracting. Ours contracted also. Wasn't because we had a whole bunch of customers leave us, but because we had a customer who used to have 100, and now they have 90. And so there was a 10% contraction. And the only way you can overcome that is to attract new customers. So we'll be handing out SIG cards and opening accounts for everybody here tonight. I'm kidding. You guys already have accounts. If we look at total loans, it was up 1.2%, first quarter 23 versus first quarter 22. But again, that's a challenge for us because we're doing two things simultaneously. Number one, we're trying to make new loans, renew existing loans, that sort of thing, and also evaluate the portfolio and make sure we're getting out ahead of any loans that are suffering financial adverse effects, right? Kind of figure out who might have a problem. And capital was up 12% in the first quarter as compared with the same quarter the previous year. Revenue up, is that 39? Yeah, 39%. That was a big number as compared with the first quarter of the previous year. And interest expense, that's a big one, up 307%. And part of the reason that is such a big percentage, anytime you see 300%, that's a lot. That's a threefold increase. But it's starting at a pretty low number. You know, interest rates for a long time were, I don't know, 10 bips or 5 bips or something like that. And if you just go to 1% as a multiple, that's a big number. Non-interest expenses, again, rent and overhead in the first quarter up 10%. As compared with the same quarter last year. And consolidated net profit, now consolidated is both the holding company and the bank together. That was an increase of 30% over the same quarter previous year. So with that, a couple of minor issues. If we look at, not minor issues, but summary points here. If we look at liquidity, one of the key things when a bank gets in trouble is what is their liquidity? How much do they have in terms of dry powder, so to speak, to take care of things? Well, at the end of the first quarter, we had 25% of our total deposits, or $78 million, in cash. So, all right, if somebody wanted to come in and withdraw some money, we had $78 million in cash. In addition to the cash on hand, we had 238 in total, or 70% of our deposits, in credit lines available to us. So we could go to the Federal Home Loan Bank or the Federal Reserve Bank, and we could borrow up to $238 million, or about 70% of our deposits. Total earnings in the first quarter 23 up 30%. I just talked about that, or that's about a $1.3 million increase in retained earnings. And our investment portfolio is cash flowing at about $2 million per month. So every 4 weeks we get roughly $1.8 million in additional cash that comes out of our investment portfolio, and that improves the liquidity. And then if we look at our bank's Tier 1 capital leverage ratio, it increased. It's increased since the second quarter of 02. Continues to get higher, 10.56%. So pretty good number there. If we look at our loan portfolio, average loan-to-value ratio for our loan portfolio is 42%. So that means if somebody had a building worth 100, our loan averages 42 against that 100. Okay, fine. Hopefully what that demonstrates is we've got pretty good protective equity. It motivates the borrower to get us paid rather than give us the collateral. The average time for reprice, 2.9 years. That's kind of an important thing because remember I was talking about those mortgage loans and they're at fixed rates for long periods of time. In our case, because these are commercial real estate loans, they reprice. And the average reprice term is about 2.9 years. And in fact, over the next 3 years, 130 million of 178 million will reprice. And that's a big deal. You might get stuck for a little while, but you're not going to be stuck for 30 years on those loans. Okay? And as I mentioned earlier, credit losses in 22 were a net recovery, and it was a net recovery of 14,000 in the first quarter. And loan delinquency was 0 at the end of the first quarter. No bank owned real estate. In terms of ownership, remember I mentioned Silicon Valley Bank had institutional ownership. So our bank has one institutional owner. It's called Bank Funds out of Chicago, and we talk to him regularly. Pretty nice guy. They're not activist investors. We had to approve them buying the shares. And they're not a bad institutional investor. There are some institutions you don't want to do business with because they'll call and beat you up regularly. These guys are pretty good. And if they needed to liquidate their position, they could. We've got a stable shareholder base. We've got about 700 shareholders in total. It's hard to know exactly because remember I mentioned some are in street name, and so I don't know how many each broker holds, but about 700. So with that much diversification, you're not likely to get too beat up by any one of them. Directors and officers own about 35% of the outstanding shares of the bank. And that, in my mind, that's an important thing. If I'm going to invest in a company, I want to understand what is leadership doing? Are they invested in that company? It has a lot to do with their motivation. If somebody was running a bank and had no investment, I would think twice before that. And recently, the board approved a $1 million share repurchase plan. Now, what this means is the board said in the event that certain circumstances happened, we could repurchase shares up to $1 million. Many times, you'll have somebody under tremendous pressure. They'll dump, 1,000 or 2,000 or 3,000 shares on the market, and it'll hurt the price. You'll see that. We're bouncing along $12.95 today. Hot dog. But then you'll see something hit, $11.50 or something like that. And you look at the volume, sometimes they're very low volume. And what we were concerned or what we were thinking about was Pacific Western, for example. You've seen that over the past number of weeks. That's a bank that's really getting beaten hard. Citizens Business Bank, it's a fine bank. There's nothing wrong with them. But they're getting beat up on their stock price. They traded at $10 for a while. And it's a good bank. Nothing wrong with them. The share repurchase plan, if we were to go into a period of time where our stock became stressed and we were trading below tangible book value, we have the ability to go in and buy those shares and protect the price. And anytime you buy a stock at below book value, it's accretive to all the other shareholders. Your book value goes up and your earnings per share go up. What else? Stock performance. I know I got a lot of slides. I'll try to go through it quickly. This is our stock performance over the last 12 months, up 13%. I did this slide a couple days earlier, but then our stock went up yesterday, so I redid the slide at 13. I feel better if I confess on this stuff, but anyway, up 13% on the last 12 months. If we compare that with the Dow Jones Industrial Average, we compared favorably. We did better throughout the year than the Dow Jones. If we compare it with the S&P, we did better. Okay, that's good. If we compare it with the NASDAQ, NASDAQ was slightly higher than we are, but if you look closely at the slide, they switched at the very end, or we kicked up. If you compare our bank with the Russell 2000, we performed better. And if you look at, this is a gold and silver index, and we performed better than gold and silver during this period of time. Next is B of A. We did a lot better than B of A. They were down 20%, we were up 13%. So B of A is going through a rough patch there. And then this is a bunch of
Higher interest rates right now, trying to get money in, right?
Yeah. What's that?
They're giving high interest yields on
Yeah.
trying to get money in.
Yeah.
Somebody said, I think they're trying.
Yeah. This is a list of banks. It's J.P. Morgan Chase, Citibank, and Bank of America. And as you can see, our bank stock performed better than all of those. J.P. Morgan was slightly higher than us up to a couple of days ago, and that's why I redid the slide. So we beat J.P. Morgan Chase. Take that, Jamie Dimon. KBW Bank Index. So Keefe, Bruyette, and Woods, they've got a bank index, which is a basket of banks that they measure, and it produces an index. It was down 30% on the year, so we perform much better than the bank index. And if we look at the NASDAQ Bank Index, it was down 30%. We, of course, were up just about 13, and so performed better than the NASDAQ Index. And then dividend. This is usually part where Rudy Carmona would stand up and say, "What about my dividend?" So our board of directors at the last meeting declared a 20% stock dividend, and to shareholders of record as of June 15th, and it's payable on July the 6th. Just as an interesting thing, so 100 shares purchased on the initial public offering is worth 459 shares when this dividend is completed. So it's been pretty good. Another thing that we're working on, this is really kind of exciting for me, and that is merchant services. So everywhere you go, people take plastic, and COVID moved that up a lot. Now, people are afraid of money. And true story, I was walking into the store on the weekend, and I look like a homeless person on the weekends, because anyway, I do. And this sweet little girl said, "Sir, would you like to buy some cookies?" And I said, "Oh, honey, I don't have any cash. I'm sorry." That quick, Mom jumped up and said, "We take plastic." So I bought cookies. But the whole world is using digital interchange, and our customers using digital interchange. And we started about 3 years ago on what's called an ISO program behind a lead bank called TIB. And so basically we would offer this to our customers, and we would install the equipment and take care of the equipment and everything else, and then we shared a lot of the profit with the lead bank, and that was fine. And so our 3 years is up, and our real goal was to be a sponsor bank. So what's a sponsor bank? Well, a sponsor bank is part of the card brand association. So in this case, you're contracting directly with the card brand, Visa, MasterCard, Discover, and American Express. And you're settling directly with the card brands. In this business, there's a whole lot of hands in the food chain. You start off with $1, and by the time you're done, it's not $1. And at any rate, so May the 1st, we started our sponsor bank program. And to put it in context, there's about 315 sponsor banks in the country. I think that's kind of cool that we're one of 315. And this has got a lot of potential traction to it. And one of our marketing goals here is, when this is implemented enough, and the TV keeps working, when this is implemented enough, we can offer this service to other community banks. And I think we've got some empathy on what they go through, and be able to offer it with a level of professionalism and integrity and disclosure. And this has got an interesting geographic element, because potentially if there were a community bank in Tucson, Arizona, you could provide merchant services to that bank. And is Tucson in Arizona? Tucson's New Mexico. Anyway, it doesn't matter. You could offer merchant services to that bank and provide a level of professionalism and start to develop a market share in Tucson that I'm not going to get other than that. So at any rate, it is a new program. Aaron Storm is heading up that project for us. He and Melinda, boy, that's a steep learning curve on that program. Anyway, a lot of fun. The other product is Zelle. As some of you may be aware, we had a product called Pop Money, person-to-person money. On June 23rd, we began offering Zelle. And the Pop Money product is sunsetting, and so Zelle comes on. Any customers you have loaded in there, Joshua, what's happening to my, never mind. Any customers you have loaded into Pop Money will automatically convert over to Zelle. So anyway, pleased about that. In terms of recognition, the bank was recognized again by the Finley reports and given the award of Super Premier Performance Bank. And I'm very pleased about that too. This is the 9th year, I think, in a row we've gotten it. Chino Champion, we got the Reader's Choice Award. Happy about that. I'd take half of that in cash. We got a 5-star rating from Bauer. We've had that for another number of years. So looking forward, I'll try to bring this to a close for you. Looking forward, what am I anticipating seeing over the near term? I think quantitative tightening will continue until two things occur, and that is unemployment gets to about 4%. Keep in mind, the Federal Reserve wants to see unemployment increase, because as unemployment increases, buying decreases and it offsets inflation. So I would pay attention to unemployment. The expressed broad target is around 4%, and follow CPI. If CPI gets down to about 2.5%, then we could imagine a scenario where the Fed stops or begins to decrease rates depending on the speed and trajectory of it. Interest rates, or Fed funds particularly, may increase another 25 to 50 bips. And that's speculation on my part. It may not increase any. I don't know. I'm not privy to what they're talking about at the Fed, but there is still quantitative tightening going on. Interest rates could remain elevated for longer than I had originally thought. Now, what I mean by that is there was a period of time where I thought second quarter, third quarter, we're going to see a significant drop in rates. We're going to resume a quantitative easing status. I'm starting to soften on that position. I think they may stay elevated for a while. And I would not be too shocked if you hear about some more events. A bank gets in trouble, something like that, and then all of the talking heads will start, giving advice on that. So don't be surprised if you see more events, but it isn't really the end of the world. It's just this thing playing its way out. And credit availability may tighten. As those deposits decrease, the ability of those banks to make loans decreases. And that may start to have an adverse effect on commercial borrowing. And world events can change everything. Limited nuclear warfare in Ukraine. I don't know about the probability of that happening, but something like that. China parks an aircraft carrier next to Taiwan. North Korea launches something at somebody else. Those kinds of things can dramatically change the landscape and kick the Fed into an accommodative mode. Keep in mind, when they see trouble ahead, they tend to drop rates in anticipation of that. So we could see things change pretty quickly toward the quantitative easing side. I think one thing, I heard an interesting quote this morning. I was on the bike watching this thing, and Warren Buffett, he said, "What creates opportunity? People doing dumb things." That's interesting. All right. I like that. Kind of simple. But the market always overcorrects. And look for good fundamental values and buy on the dips. If you see something like a Citizens Business Bank that, hits $10, it's a good basic bank. And I'm not encouraging Citizens. I think you should dump them and come over here. But anyway. But it's good fundamentals, and I think the key thing is don't lose your head. Don't lose your head on stocks and investments. Don't lose your head on deposits. Don't lose your head on your real estate investments, etc. These are cycles. These come and go. Typically, I would not sell at a loss. If you're in a loss position on a stock or a real estate or a who knows what, once you sell, your ability to come back from that is zero. You've sold your position out. You're locked into a loss. So I wouldn't recommend that. And then the last thing is recessions are normal and necessary. You can't be on expansion all the time. You've got to breathe in and out. And so it's normal. And I think the key thing is don't panic. So with that, any questions? Yes, sir.
There's quite a bit of controversy on this right now, and that is the national debt is around $32 trillion right now.
That was at 5 o'clock. It's up since then, yeah.
And some claim that doesn't have any effect on inflation at all. How do you feel about that? Surely it must have some effect on inflation.
So inflation is caused by two things: just increasing the monetary base, the number of dollars on the monopoly board, and then economic activity. Both have the same effect of increasing inflation. Increasing the national debt, increasing the monetary supply is inflationary. That's pure and simple. That's all there is to it. Some people get elected into Congress based on I don't know what, but and then there's somebody there to interview them for something and presume they know what they're talking about, and many times they don't. I would just disregard that sort of thing as somebody who has a particular angle they're trying to promote. My opinion on the current budget things is there's a lot of theater. Somebody said one time there's more heat than light here. I guess I'm cynical enough to say they will resolve something at the 11th hour. They will increase the spending limit, and the sun will come up the next day. But each side is going to try to get political gains on the other one and blame the other one for something. Either being reckless spender or being a mean money grubber, whatever. That's just Washington, and there's always something happening there. So, anyway, yeah. Yes, ma'am?
Real estate, how do you see the trend of real estate?
Yeah.
Going up, going down, when you study specifically?
So, generally speaking, I'm bullish on real estate because in an inflationary environment, the value of assets will increase. And I've told a story on Trish and I bought a house, I don't know, 28 years ago. Spent $167,000. I was sure I was going to go broke. And I look back, what did I do wrong on that? I didn't buy the whole street. And so fundamentally, I am bullish on real estate. Now, having said that, the fundamentals have to be in place. There's got to be sufficient cash flow. It's got to be well positioned. It's got to be in the right place on the map. It's got to, there's a lot of variables there. We can all look to some investment that didn't go well and say, well, see, that's the reason. Well, you can invest a lot of things that don't go well. And then timing is important. You're going to go up and go down. And that's the nature of this business. When my grandfather was a home builder, and I remember as a kid, I was about that tall. It was just a few weeks ago. But anyway, and he was telling me, he said, in 1958, you could stick a shovel in the ground, and there was somebody there to offer you money for this house. He said, by 1966, you couldn't give that house away. And I was maybe 7 years old, and I started thinking, cyclical economic factors. That's kind of cool. I didn't use those words, but anyway, that was my first introduction to the cyclical nature of real estate demand, and it ebbs and flows. But over time, it's a sound investment.
What's the bank's 5-year plan on expansion and branches?
That's a great question. I don't have a lot of hard and fast things. I see folks get into trouble when they do that. They say, I want to be at 14 branches by Thursday. Yeah, where did that number come from? Was that an important number? Is it ego? And we may go through some tough patches here, and I want to make sure we're not overextended. Now, having said that, I would love to have a Corona branch. I have been snooping around Corona for a long time. And but then this pandemic hit. No, there went that idea. And so then not only do I like that part in terms of geographic expansion, I've got to get the right talent. You got to get the right people to run this thing because buildings alone don't do the business. And I'd like to own the real estate. We own 3 of our 4 locations. I've got an option to purchase the 4th. So I'd like to find something we can buy. In terms of what is our growth and expansion, in terms of branch expansion, we might do a 5th this year, maybe not. I'm not sure. Only when it's right.
Do we need so many branches if everybody's doing online?
Not as much. You definitely don't need the square footage. Who in the world needs 20,000 square feet? Not us. Actually, this is more office than anything else, and we figure out a way to mess up the carpet. But anyway, new branches, there was a time the average branch was about 9,000 square feet. Today, the average branch is 3,000 or less. So just to economize. Yeah. Yes, sir?
You showed quite a bit of flight of deposits out of the
Uh-huh.
banking industry.
Yeah.
Have you been significantly less than the banking industry average?
Well, we were impacted in the first quarter. It was down 10%. Now it's come up since then. We're about 7 million higher than that slide was. I should have redone that one, but it was first quarter numbers. But deposits are down industry-wide. And again,
What is the industry average down?
I don't know that number. Yeah.
Thank you.
I could look it up, but I don't.
Yeah, no big deal.
Yeah. All right. Good. What else? Yes, sir.
The move to digital currency,
Yes.
is that impacting the bank in any way?
You mean CBDC? Central Bank Digital Currency, CBDC. I don't like anything about it. So the idea is that to be, cool and trendy, the central bank, the Federal Reserve, will issue digital currency. So now, if I'm a depositor and I acquire digital currency, it means that deposit's going directly to the Federal Reserve. It doesn't go to the banking system. It goes around the bank to the Federal Reserve. Now, well, you're not my customer. You're the Federal Reserve Bank customer. So if you got a problem on an account, I don't know, call them. That's the way it's designed. And as a bank, now I'm borrowing from the Federal Reserve in order to make loans. So now I don't have any relationship with my customers. I don't like anything about it. It's been kicked around. It is generally disliked by everybody except the government. And, I don't know. Yeah, I like free markets. I like independence. I don't like the government. Yes.
What's the difference between cell and digital? Cell, are we going to be using cell?
Versus pop money, yes. Great question. So Zelle was created by the 5 largest banks as a digital interchange and would allow you to make a payment to a cell phone number or an email address. And it allows you to settle a transaction very quickly with very limited information. So you see Zelle a lot in nail parlors or nail shops. They'll settle with Zelle. And so you got your phone and you say, phone number is 123456, and you send them X number of dollars and off it goes. They've got an account at Zelle that knows what that phone number, which account it credits, and the deal settles out. So for consumers, it's really a good thing. It doesn't work on business. And that's the part that isn't fully in place. So consumers are great, but it doesn't work for business yet. Mm-hmm.
But isn't it going to be more monitored now by the federal government, where they actually have to pay the tax and everything on anything transferred over $200?
I thought it was 6, but yeah. Yes. Yeah. Yeah. I think we've got to get pretty comfortable with the government monitoring things. And, I don't encourage anybody to not be up front on things. So, anyway, we have to. Yes, sir?
What are your plans, Dan? You've been around a while and you've done a heck of a good job.
Thank you.
Are you going to be around a while longer?
One would think I should get out now while I'm still doing okay, before I goof this thing up. So last year, when that question was asked, I said I had 5 years left. So I guess I got 4 years left. How's that? The good news is my health is good. I'm having fun. Projects like this merchant service thing are interesting to me. I think they're still good that we can do. And if we reach a point, and I got to tell you, there are those occasional days where I think, oh God, how much longer I can do this. I heard getting old is like the same as when you're young, except you wake up every day feeling like you have a cold. Some days my cold is worse than others. But on the other hand, and I think it's good for somebody in leadership, don't just do it until you're mad and you quit. Start to phase this out. Start to train the other folks to do your job so that I hate golf, but so I could do something. I got to find a hobby. So my goal over the next 4 years is to do a better job of paving the way for new folks to come in and do what I do.
Are you finding somebody for replacement?
Not at all. I'm teasing. No, actually, it is great. We have got such a talented team here. Everybody here is first class. You can't swing a cat without hitting a Bowman around this place, so I'm kind of partial to them. But my oldest son and my middle son both work for the bank. My youngest son is behind the wall. My wife's over there, so I'm kind of up to my eyeballs in Chino Commercial Bank. Anyway.
The fastest growing age group is over 85. That's the fastest growing age group in the U.S.
Not physically growing, no. Yeah, yeah. Okay, all right, yeah.
You stop to think of it. You look at, some of the people that are 70, 80, 90, even up to 90, still productive. So that old 65 thing, I think, is out of date.
Yeah,
It's kind of out
yeah,
of date, really.
yeah.
Reality.
When I was young, somebody who was 65 was old, and somebody who was 80 was dead. Yeah. Right. Today, you see these 80-year-olds passing me on the bike, and Bernie, he's sharp as a tack. And like I said, he'll be 91 this year. So let's just...
Redefining really productivity and contribution.
I think so.
Stay on the board at least, wouldn't you?
Oh, of course, yeah. Nah.
You can retire from getting an income, but you can't retire from making a contribution. Because if you do, you'll dry up and boil.
I don't want to retire from the income part.
Nothing else, the grandkids will spend.
That's the thing. You wonder, what do I keep making it for? I'm not going to spend it. Because you spend most of your life being a cheapskate, it's kind of hard. I swear, I was at Home Depot saying, oh, this one's 97 cents, this one's 87. Oh, I could buy the whole aisle if I wanted to, but I'm such a cheapskate.
I said, but when you really need the money, you don't have it, and when you don't need it, you got lots of it.
That's one of many, many paradoxes. So, yeah. Oh, Larry, you know how long I'd last in Washington? Oh, they'd kill me because I just blurted out, and I'm so politically insensitive. I don't know, but anyway, they'd probably get me elected and probably get me killed all at the same time. But anyway, yes, sir.
This is a personal for our business.
Mm-hmm.
Our world that we be in. We were offered by Chino to take a loan.
Mm-hmm.
We don't need money, we have money.
Mm-hmm.
And we're paying our loans and all that, and our business is okay. But if we were to get money, what would be a smart place to use it?
Boy, that's a big question.
What was the question?
So the question was, apparently we wrote her a letter and said, you want some money? We'll give it to you. We do all that a lot. And so the question was, if we did have a loan or you took a loan or you had money to invest, where is a good place to invest? And it is such a difficult question to answer because... Okay, all right. Oh, that's fine.
My question was, we were offered a loan by Chino Bank,
Right.
and we are okay in our business, and we have, cash flows that we don't need to borrow. However, if we were to borrow from Chino, where is a good place to put that money in use? That it will cover our payment, but also will bring in money. So what type of investment or
Yeah.
use in general?
Yeah. That is such a tough question to answer right here at the podium. I guess my one piece of advice is invest in something you are familiar with and you've got some competency in. One of the challenges to getting some money is a whole lot of people will reach out to you and say, I will show you how to triple that money in no time. I would stay away from that kind of thing. So if you're familiar with real estate, that's where I would look. If you're familiar with a particular business model, that's where I would look. Yeah. And always look in your own business first. Yeah. Good. All right. Good. Anything else? Yes. Yes, ma'am.
After I listened to your presentation,
Mhm.
and the Chino Bank, the share is around $13,
Right, right.
What do you think if we will, the shareholder will increasing our share? So it's a good thing to invest
Yes.
right now?
Yes.
Or
Okay. All right. So if I understand what you're saying, we're currently at around $13, $12.95 today. And do I think it is a good time to buy? Is that correct? Am I saying it correctly? Well, okay. So current book value $12.85, right? So we're trading just a little over book value, pretty close to book value. Our return on average equity last year was just about 16%. Okay, so good rate of return on the investment. I don't want to go down the road of saying it's a good idea or it's not a good idea because I don't want to give investment advice. I guess I'll just leave it with I buy more stock all the time. So, yeah.
I didn't even think your stocks were available. You sometimes sold them, sometimes didn't.
Mhm.
Or what do you have? You have in stocks now that you're going to sell?
No.
so can you
Well,
trade in the bank?
so so then
Kind of interesting.
Yeah.
We can sell stocks today. Well, no, you can't now. I
So
don't really understand it.
Sure. So our stock is, as we know, it's publicly traded. It sells every day. It trades up and down and what have you based on activity. There's a market maker. There are two market makers primarily for our stock. Mike Natzik, I had mentioned Hilltop Securities. Mike's our primary market maker. We do trades all the time with Mike. So it's available. Those aren't new shares issued. They're existing shares. So one shareholder sells, another one buys. Yeah.
Yeah, we misunderstood that.
Okay. All right. Good. You're welcome. Good. All right. Anything else? All right, guys. We've got lots of food left. So what's that? Raffle. There we go. All right. Thank you for reminding, Sylvie. Good. So let's see. Gigi, who's going to pull the magic number? Carol is going to do it. Excellent. Okay. Ralph Reed. All right. Ralph. What's that?
Where do I go to collect?
To
my
collect
prize?
your prize. I think it's over there on the table. There you go. All right. Good job, Ralph.
Thank you, Dan. Good job.
Thank you. Thank you for coming tonight.
Lovely